Hi, so we are now in the part two of our topic for notes receivable. So in this part two, we will learn the subsequent measurement and the presentation of your notes receivable. So remember in our part one discussion, we learned about the recognition and initial measurement. So we've learned about the different methods or the different ways on how we recognize and initially measure your notes receivable. So for this lesson, we will learn about the subsequent measurement, and also we will learn about the presentation of your notes receivable. So subsequent measurement of notes receivable. Okay, so for subsequent measurement of notes receivable, generally, again, your notes receivable can be classified as either short-term or a long-term note. So if that is a short-term note, guys, that can either be an interest-bearing or a non-interest-bearing note. A long-term note can either be an interest-bearing note or a non-interest-bearing note. So what is the just a recap, what is the initial measurement of your interest-bearing short-term note? Fees amount, fees amount. How about your interest-bearing long-term note? It depends if with reasonable interest rate or without reasonable interest rate. If with reasonable interest rate, we initially measure it at face amount. If without reasonable interest rate, we measure it at present value. If that is a non-interest-bearing note, we measure it at present value. But take note, if the cash price equivalent is given, use the cash price equivalent. We go now to the subsequent measurement of your notes. So how do we subsequently measure your notes receivable? If the initial measurement is face amount, we subsequently measure it still at face amount. However, subject to impairment. Subject to impairment. And what is the impairment, or what is the subsequent measurement after impairment? We call it your recoverable cost. Recoverable cost. Okay, so this is your recoverable cost. Or most call it recoverable historical cost, but it's still recoverable cost. So again, if the initial measurement is based on face amount, the subsequent measurement is still face amount, but subject to impairment, which is your recoverable cost. If the initial measurement is present value, the subsequent measurement is using amortized cost. Amortized cost, that is based on effective interest method. Based on effective interest method. So what is the subsequent measurement now of this item? Subsequent measurement is still at face amount. This one, face amount. This one is measured at face amount, therefore subsequent is face amount. This one is measured at present value, therefore we measure it at amortized cost using effective interest method. This one is measured at present value, therefore our subsequent measurement is amortized cost using effective interest method. Okay, we go back. So if ever, for your subsequent measurement, we follow these rules. We follow these rules. If the initial measurement is face amount, we measure subsequently also at face amount, but it is subject to impairment, which is the recoverable cost. If the initial measurement is at present value, our subsequent measurement is amortized cost using the effective interest method. Our subsequent measurement is the amortized cost using the effective interest method. Okay, so we don't have any problem as to the subsequent measurement of notes receivable initially measured at face amount. Okay, so we do not have any problem on the subsequent measurement of notes receivable initially measured at face amount because it is only equal to your face amount still. Okay, so no problem at all. But how about for the subsequent measurement of notes receivable initially measured at present value. How do we subsequently measure it? Using amortized cost, effective interest method. Okay, amortized cost, effective interest method. So how does your amortized cost using effective interest method works? So this is a new term for you. So when we say amortized cost, we try to amortize the difference of the carrying amount and the fees amount. So remember, under your initial measurement, we said that your carrying amount now is not equal to your fees amount. So we have now a difference. So this difference now will be amortized. And what is the method of amortization? Method of amortization, we call it effective interest method. We call it your effective interest method. So how does your effective interest method works? So this is our main model in using your effective interest method. We call this your amortization table. We call this one your amortization table. So we have here your interest received. Okay, we start with interest income. And then we have your interest received. And then we have your, wait, masyadong malalaki. Interest income, interest received. And then we have your collections on principal. We have your amortization, and then we have your carrying amount. So beginning, so this is January 1, year 1. Tapos, let's say this is December 31, year 1. So the carrying amount here, initially, this is the initial measurement. Okay. Your interest income is computed as equal to your initial measurement multiplied by your effective interest rate. Initial measurement multiplied by your effective interest rate. Interest received is equal to your principal balance multiplied by your stated or nominal rate. Okay? Multiplied by your stated or nominal rate. Principal balance multiplied by stated or nominal rate. And then collections on principals, these are your different annual repayments. Annual repayments. So this can be equal annual repayment. It can be equal or unequal. Okay. And then your amortization is equal to interest income less interest received less collections. And your carrying amount, subsequent carrying amount here, this one, this value here, after your initial carrying amount, your subsequent carrying amount is equal to your initial carrying amount plus your amortization. Okay, so take note, guys. We go back. The subsequent measurement of notes receivable initially measured at present value is your amortized cost using effective interest method. So we say we amortize the difference between the carrying amount and the face amount using a method of amortization. And the method of amortization is known as your effective interest method. And the general formula or the general form in your effective interest method is through your amortization table. It's through your amortization table. Okay? Okay, so again, the general form is your amortization table. Okay, guys, I'm sorry if ever you heard a music that played. I don't know how it happened. Agad-agad na lang may nag-play. So pag may nag-play dito sa recording na to, sorry na lang. Okay, so we have here your effective interest method. So we follow this amortization table. We have your interest income, interest received, collections on principal, amortization, and carrying amount. For interest income, it is computed by multiplying your initial measurement or your carrying amount to your effective interest rate. Your interest received is equal to your principal balance multiplied by your stated or nominal rate. Then we have your collections on principal that is equal to your annual repayment or equal or unequal payments. And then we have your amortization, which is equal to your interest income less interest received less collections. And your carrying amount is equal to your initial measurement or initial CA, so your beginning CA plus amortization, So sir, how about if our amortization here is positive? Edi you add lang. Sir, what if our amortization is negative? Edi, negative yan. Ibawas mo naman. Okay? So again, take note guys, we will only use this for notes receivable that is initially measured at present value. Okay? So the subsequent measurement and the amortization table will only be used for notes receivable that are initially measured at present value. So let's have an example. So first, we only have two notes receivable that is initially measured at present value. We only have two notes receivable that is initially measured at present value. That is your long-term interest-bearing note with unreasonable rate, or known as your long-term interest-bearing without reasonable interest rate. And then we have your long-term non-interest-bearing note. So let's have an example for the subsequent measurement of a long-term interest-bearing without reasonable interest rate. So without reasonable interest, okay? So, say for example, we have here a note. A 3 million note is received in consideration for goods sold. The note is to be repaid on January 1, year 1. A 3 million note is received in consideration for goods sold. The note is to be repaid after 3 years. The note bears an interest of 3%. Bears an interest of 3%. The market interest rate on similar notes is 12%. So on January 1, year 1, a 3 million note is received in consideration for goods sold. The note is to be repaid after 3 years. The note bears an interest of 3%. The market interest rate on similar notes is 12%. So we compute first for the initial measurement. So since this is a long-term interest-bearing note without reasonable interest, our initial measurement is composed of your PV of principal and PV of interest. Okay, so our PV of principal is equal to 3 million multiplied by PV of 1 and is equal to 3, I is equal to 12%. And our interest is equal to 3 million multiplied by 3% multiplied by PV of ordinary annuity of 1 and is equal to 3 I is equal to 12%. So let's compute for the initial measurement. So our initial measurement is 3,051,505.56. We proceed with your subsequent measurement. Using your amortization table. So first column, we have your interest income. Second column, interest received. Third column, we have your collections. Fourth column, we have your amortization. Fifth column, we have your carrying amount. So we have here January 1, year 1, December 31, year 1, December 31, year 2, and December 31, year 3. Okay, so our recurring amount on January 1, year 1 is 2,351,505.56. So on December 31, year 1, of course, we will have an interest income. The interest income, again, is equal to your carrying amount multiplied by your effective interest rate. So 2,351,505.56 multiplied by 12% will give us 282,180.67. Our interest received is only equal to your principal times your stated rate. So our principal is 3 million times 3%. So 3 million times 3% will give us 90,000. Do we have any collections on the principal? None, because the principal will be repaid at the end of 3 years. Therefore, we will not have any collections at all. So this is 0. So our amortization is equal to interest income less interest received less collection. So 282,180.67 less 90,000 will give us 192,000. I'm sorry. 192,180.67. So our carrying amount is equal to initial carrying amount plus amortization. So our now carrying amount on December 31, year 1 is equal to 2,351,505.56 plus 192,180.67. So this will give us 2,543,686.23. We repeat the process for year 2. So for year 2, our carrying amount, to compute for interest income, carrying amount times effective interest rate. So 2,543,686.23 multiplied by 12% will give us 305,242.35. Our interest received is still 90,000. That is the principal times the stated rate. Collection is 0 because there is no principal repayment. So 305,242.35 less 90,000 will give us 215,242.35. So to compute for carrying amount is equal to initial carrying amount, this one, plus the amortization. So 2,543,686.23 plus 215,242.35. Okay, so we have here 2,758,928.58. Next, we continue on December 31, year 3. We get first for the amortization by getting the interest income. So 2,758,928.58 times 0.12 will give us 331,071.42. Then we have here 90,000 for interest received, 0 collections. So we will have an amortization equal to 241,071.42. So we add that, we will have 3 million pesos. So as you can see, guys, if ever there is no principal repayment, the after amortization, the carrying amount is equal to your face amount. Okay, so if there is no principal repayment after amortization, the carrying amount is equal to face amount. Okay, okay. That's for our subsequent measurement for this example. So this is a long-term non-interest bearing note, long-term interest-bearing note without reasonable interest rate. However, the payment of the principal is at the end of the term of the note. At the end of the term of the note. Let's have another example, number 2. So second example, sorry. On January 1, year 1, a 3 million note is received as a consideration for the sale of goods. The term of the note provides that 1 million is payable every end of the year. Okay? On January 1, year 1, a 3 million note is received as a consideration for the sale of goods. The term of the note provides that 1 million is payable every end of the year. The note bears a 3% interest, and the market interest rate on similar notes is 12%. Okay, so we try to prepare the subsequent measurement or the amortization table of this example. So before we can proceed to compute for the subsequent measurement, of course, we need to compute first for the initial measurement. So the initial measurement is equal to your PV of principal and PV of interest. So the principal is payable for 1 million every end of the year. So kung 3 million yan every end of the year, how many years siyang magbabayad? 3 years. Kasi nga 1 million each year. So we have here 1 million multiplied by PV of ordinary annuity. N is equal to 3. I is equal to 12%. Next, PV of interest. Since there will be a decrease on the value of our principal, then the interest will also decrease. So first you have 3 million times 3%. Then we have 2 million times 3%. And then 1 million times 3%. So this is on year 1, year 2, and year 3. Sir, why is there a decrease again? Because there is a principal repayment that is payable every year end. Multiplied by PV of 1. Here, n is equal to 1 for 1 period, n is equal to 2 for 2 periods, n is equal to 3 for 3 periods, and I is equal to 12%. So what is our initial measurement? What is our initial measurement? So let's compute. So this will provide us 2,551,373.45. Okay, so guys, here in the PV of interest for year 1, PV of interest, we will get here 90,000, right? 90,000, 3 million times 3%. Here, 60,000, 2 million times 3%, and 1 million times 3% is 30,000. Then you get the PV of 1, n is equal to 1 for 90,000, n is equal to 2 for 60,000, n is equal to 3 for 30,000, I is equal to 12%. I is equal to 12%. Okay, so we will get 2,551,373.45. So we prepare our subsequent measurement using your amortization table. Okay, so let's prepare our amortization table. We have here interest income, interest received. We have your collections, and then we have your amortization, and then we have your carrying amount. So on January 1, year 1, what is the carrying amount? 2,551,373.45. 2,551,373.45. Okay. So on December 31, year 1, let's compute for the interest income. So interest income is again computed as your carrying amount multiplied by your effective interest rate. So 2,551,373.45, 2,551,373.45 multiplied by 12% will give us 306, 164.81. 306, 164.81. And our interest received for year 1 is equal to 90,000. Okay, so our interest received for year 1 is equal to 90,000. And our collection pertaining to principal is every year 1 million, right? Every year 1 million. So 1 million yan. Let's compute for amortization. So 306,164.81 less 90,000 less 1 million will provide us a value of negative 783,835.19. Okay, 783,835.19. So since this is negative, therefore our carrying amount will decrease. Unlike in our first example, wherein the amortization is positive, here the amortization is negative. Therefore, we will have a decrease on carrying amount. So 2,551,373.45 less 783,835.19. So we will get 1,767,538.26. Next, December 31, year 2. December 31, year 2. So our interest income is 1,767,538.26 multiplied by effective interest rate of 12%. So we have here 212,104.59. Our interest received is still at 90,000. And our collections is still at 1 million because the 3 million is payable annually for 1 million. Next, we have your amortization. So your amortization is equal to 212,104.59 less 90,000 less 1 million. This will give us 877,895.41. 877,895.41. So our carrying amount, therefore, is equal to 1,767,538.26 less 877,895.41. So we have here 889,642.85. 889,642.85. Next, on December 31, year 3, the last year. So let's compute for our interest income. That is 889,642.85 multiplied by 12%. So we will get 10677.15. 106,757.15. And then our interest rate is 90,000. Our collections is still at 1 million pesos. So our amortization is equal to 106,757.15 less 90,000 less 1 million will provide us 900. No, I think we had an error on our values of interest received. Our second year interest received is 60,000. Our third year interest received is 30,000. So let's recompute. Sorry guys, let's recompute. So 212,104.59 less 60,000 less 1 million will provide us 895.41. And then our carrying amount is equal to 1,767,538.26 less 847,895.41. So we have here 919,642.85. 919,642.85 multiplied by 12%, we will get 110,357.15. 110,357.15 less 30,000 less 1 million will give us 919,642.85. Okay, then this one is 0. Our carrying amount is 0. So notice guys, note that if the note has a principal repayment or a collection from principal, the carrying amount of the note at the end is 0. Okay, is 0. So a while back, if ever there's no principal repayment on or collection on the note, then the carrying amount will be equal to the face amount. But if ever there is now a principal repayment or collection, then the carrying amount at the end is 0. Okay, so how do we interpret this amortization table? So since it's called subsequent measurement, you're asked, what is the carrying amount at the end? So what is the carrying amount on December 31 year 1? So your answer is this one. What is the interest income on year 1? This one. Okay? So sir, how will we make our entries? Your interest income is recorded this way. So you just debit interest income. You just credit interest income because it's an income at the amount. And then you debit either your collections on your discount or your premium. So it is like a reduction on your discount or your premium. Dito kasi discount siya, kaya i-debit natin yung discount on notes receivable. Okay? So discount on notes receivable. Then next, we have your debit to cash. For your interest received, that is a debit to cash and a credit to discount or premium. Discount on notes receivable. Okay. So dito, discount na naman yung ginamit natin kasi discount yung sample natin. So this is to record the interest income. This one is to record the interest received. And then we also have your another entry. So we debit cash, we credit notes receivable to record the collection on the notes. So to record the collection on the notes, we have your cash and notes receivable. Cash and notes receivable. Okay? So yan, pagka subsequent measurement, amortization table lang, what's the carrying amount on December 31 year 1? Eh di tumingin ka sa December 31 year 1. Asan yung carrying amount? Ayan. Ayan yung carrying amount. So yan siya. What is the interest income on year 2? Andito yung year 2, di ba? Ayan yung interest income. Ganon. Okay? What is the carrying amount on December 31 year 2? Year 2 ulit. Carrying amount. Ayan. Ganyan siya. Okay, so subsequent measurement, we record the interest income, we also record the interest received, and we record the collection on the notes. And take note, the amortization table is only applicable for those notes that initially measured at present value. Sir, how about on our notes that is initially measured at face amount? What are the items of subsequent measurement? We already learned that already. That is the face amount. And since we can recognize also interest, you can also record interest. And we learned already how to compute for the interest, whether it is compound interest or a simple interest in the part 1 of our lecture. Okay? So that's how we use your amortization table for your long-term interest-bearing notes without reasonable interest. And we gave example as to one type wherein here, nag-zero yung, nag-equal siya sa carrying amount. So pag nag-equal siya sa carrying amount, there is no principal repayment. After amortization, the carrying amount is equal to your face amount. If there is a principal repayment, after the end of your amortization, the carrying amount is 0. Take note, if there's no principal repayment, to check whether you properly prepared your amortization table. So if there is a principal repayment at the end, the carrying amount must be 0. But if there is no principal repayment, the carrying amount at the end is equal to face amount. Okay, so that's it for our long-term interest-bearing notes without reasonable interest. We proceed to long-term non-interest-bearing notes. Long-term non-interest-bearing notes. Okay. So we will only have, again, 2 examples here. We're in an example that there's no principal repayment and there's principal repayment. Okay. So example 1, receive a 3 million note on January 1, year 1, receive a 3 million note as a consideration for the sale of goods. Okay, so the note is to be repaid after 3 years. The note is to be repaid after 3 years. The note do not bear an interest. The market interest rate on similar notes is 10%. Okay, so on January 1, year 1, receive a 3 million note as a consideration for the sale of goods. The note is to be repaid after 3 years. The note do not bear an interest. The market interest rate on similar notes is 10%. So we determine the initial measurement. Since it is to be repaid after 3 years and it does not bear an interest, we just get the present value of principal. So the present value of principal is equal to 3 million multiplied by PV of 1, N is equal to 3, I is equal to 10%. So what is our initial measurement? Our initial measurement is equal to 2,253,944.40. Okay. We proceed now to our subsequent measurement. So to our subsequent measurement, we prepare again an amortization table. So we have here your interest income, interest received, and then we have your collections on principal. Then we have your amortization, and we have your carrying amount. So January 1, year 1. So our carrying amount on January 1, year 1 is 2253,944.40. And then on December 31, year 1, our interest income, again, is equal to your carrying amount multiplied by your effective interest rate. So 2,253,944.40 multiplied by 0.10 will give us 225,394.44. Okay, do we have any interest received? None. Why? Because here it is non-interest bearing. Therefore, guys, you should note that in a non-interest bearing note, no interest received. No interest received. Do you have any collections? Since this is to be paid after 3 years, no collection. Amortization, therefore, is 225,394.44. Our carrying amount then is equal to 2,479,338.84. 1231 year 2. So interest income again is equal to your carrying amount multiplied by the interest rate. That is 10%. So we have here 247,933.88. Interest received is still 0. Our collections is still 0. Therefore, our amortization is equal to 247,933.88. Our carrying amount, therefore, is equal to 2,727,272.72 or 0.73. And then we have your December 31 year 3. December 31 year 3. So our interest income is equal to carrying amount times effective interest rate. So that is 272,727.27. Interest received is again 0. Collections is again 0. So what is our amortization? 272,727.27. So our carrying amount is equal to 3 million. 3 million. So again, why? If there is no collections or principal repayment, at the end, what did we say? Carrying amount is equal to the face amount. Carrying amount is equal to your face amount. Okay. So that's it for the subsequent measurement or preparation of amortization table for a non-interest bearing long-term note. Next, another example. So on January 1, year 1, receive a 3-year note in consideration for the sale The note is to be repaid in 3 equal annual installments every December 31, starting December 31, year 1. The note do not bear an interest. The market interest rate on similar notes is 10%. Okay, so on January 1, year 1, receive a 3-year note in consideration of the sale of goods. The note is to be repaid in 3 equal annual installments every December 31, starting December 31, year 1. The note do not bear an interest. The market interest rate on similar notes is 12%. Okay, so non-interest bearing long-term notes still. So we just need to get, for the initial measurement, the PV of the principal. Since now the principal is to be repaid in equal annual installment every end of the period, we should use present value of ordinary annuity. So what is the 3 equal annual installments? So 3 million divided by 3 is 1 million times PV of ordinary annuity. N is equal to 3, I is equal to 10%. So our initial measurement is equal to 2,486,851.99. Okay, so our initial measurement is 2,486,851.99. So what's the difference of this example from the previous example? The previous example do not have an annual installment. Here, we already have an annual installment, or known as your collections over the note, or the principal repayment over the note. So we prepare the subsequent measurement. So on your subsequent measurement, we have your interest income, interest received, we have your collections on principal repayment, we also have your amortization, and we have your carrying amount. So January 1, year 1, December 31, year 1, December 31, year 2, December 31, year 3. Okay, so let's compute now for our interest income, and let's prepare for our amortization table. So carrying amount on January 1, year 1, we have 2,486,851.99. And then our interest income is equal to 10% of that value, because interest income is equal to your carrying amount multiplied by your effective interest rate. So that is 248,685.19. And then our interest received is still 0. Take note, always 0 if non-interest bearing long-term note. Always 0 if non-interest bearing long-term notes. So collections, we have now a principal repayment of 1 million each year. So amortization is equal to interest income less interest received less collections. So we have here a value equal to 751,314.80. Okay, 0.80. So our carrying amount therefore is equal to, so 2486 2486851.99 less 751,314.80. We have 1,735,537.19. December 31 year 2 is still carrying amount multiplied by your effective interest rate. So we have here 173,553.72. Interest received is 0. Collections is 1 million. Amortization therefore is equal to 826,446.28. So 1,735,537.19 less 826,446.28. We have here 909,09091. So we compute for the interest. This is equal to 90909.09. 0. Collections, 1 million. Amortization is 909,090.910. Okay, so again, if there is a principal repayment at end, carrying amount is equal to 0. If no principal repayment at end, carrying amount is equal to face amount. Okay, so what's the use again of this amortization table? You can already determine the amount of interest income. You can already determine the interest income. You can already determine the carrying amount at the end of the period. So depending on the period, so year 1, year 2, and year 3. Okay, so again, what did we learn regarding your subsequent measurement? We learned about your amortization table, how to prepare your amortization table, what is the effect of your amortization to the carrying amount, and what is the ending carrying amount if ever there is a principal repayment or no principal repayment from the note. And how do we compute for your interest income? Again, it is based on the effective interest rate, so carrying amount multiplied by effective interest rate. And then you also know your interest received and your collections, and how do we record them or account for them subsequently in our books, okay? So again, no problem on the subsequent measurement if ever the note is initially measured at face amount. Problem arises if ever our notes are initially measured at present value. We need to prepare an amortization table. Okay, so we're done with subsequent measurement. Last topic for notes receivable, the presentation of our notes receivable presentation. So when we talk about presentation, we classify the note as either current or non-current. Current or non-current. So again, it will be current if ever that is a short-term note. Current if ever that is a short-term note. How about a long-term note? So we look if ever that is a long-term note, if it is a long-term note with principal repayment or without principal repayment. If that is a with principal repayment and that is a long-term note, the principal repayment or amortization is the current asset. If without principal repayment or there's no collections on the note becomes current only if collectible within 1 year. Okay? Again, the presentation, if ever current, short-term note, always current. Always current. How about a long-term note? So we look whether the long-term note is with principal repayment or without principal repayment. If it's with principal repayment, the principal repayment or amortization is the carrying amount. And if that is a long-term note, without principal repayment, the note becomes current only if collectible within 1 year. Okay, how about non-current? For non-current, this applies only for long-term note. For long-term note. If it is with principal repayment or without principal repayment. If it's with principal repayment, the amount of non-current is the carrying amount subsequent to the date of reporting. Later, we will discuss what does your carrying amount subsequent to date of reporting means. Next, if it is without principal repayment, the carrying amount is always non-current unless the note now is collectible within 1 year. Okay, so we follow the 1 year period here in your without principal repayment. Okay, so madali lang naman intindihin to, yung pag-collectible within 1 year. So magigets natin yan. Ito yung medyo weird, yung long-term note with principal repayment. So we said, if it's with principal repayment, the principal repayment or amortization is the carrying amount for the current asset. And if it is a long-term note for non-current with principal repayment, the carrying amount subsequent to the date of reporting is the non-current portion. Okay, so this is the non-current portion, the carrying amount subsequent to date of reporting. Let's have an example. So we copy this one first. So we copy this. Okay. Okay. So we have here, right? This is an example of a long-term note with principal repayment. So this is an example of a long-term note with a principal repayment. So wait lang guys. Just copy it as a whole so that medyo mas maayos siyang tingnan. Okay. Now, we said that the current portion of the long-term note is the principal repayment or the amortization. Okay. Ay, wala palang principal repayment to. Kuha tayo ng may principal repayment. Ito. Wait lang guys, i-copy lang natin para maintindihan natin. Erase. Okay. Ayan. So may principal repayment dito. Long-term note with principal repayment. Alin dyan yung current at alin yung non-current. Okay. So this is the carrying amount, right? So on January 1, year 1, you will have a carrying amount of note amounting to 2,486,851.99. So the question is, what is the current portion and what is the non-current portion? Because guys, this is a with principal repayment. We said that the current portion is the amortization and the non-current portion is the carrying amount subsequent to. So if that is 2486, what is the amortization? This one, right? And what is the carrying amount subsequent to date of reporting? If this is the date of reporting, this is our carrying amount. Okay, this is our carrying amount subsequent to date of reporting. So our current is equal to 751,314.80, and our non-current is 1,735,537.19. So pag tinotal mo yun, ang makukuha mo pa rin naman is 2486,851.99. Yun nga lang, kailangan kasi nating alamin yung current or non-current. Okay, next, on December 31, year 1, what is the carrying amount of note? That is equal to 1,735,537.19. Now, you need to determine again the current portion and the non-current portion. The current portion is equal to the amortization. So, ang amortization natin, next amortization yan is 826,446.28. Okay? The non-current portion is the carrying amount subsequent to date. So 909,090.91. So pag i-total mo lang din naman yan, ang makukuha mo ay 1,735,537.19. Okay? So again, ang problema mo lang dito kung paano natin siya i-present, whether it's current or non-current. So ang problema lang natin, paano natin siya i-present, whether current or non-current. Okay, so we go back to the rules. So presentation of your notes receivable. Current applies to short-term note. It is always current. Long-term note, it depends whether the note is with principal repayment or without principal repayment. If the note is with principal repayment, the amortization is the current asset. The amortization is the current asset. So the subsequent amortization is the current asset. Next, if it's without principal repayment, the note becomes current only if collectible within 1 year. So for example, we have a long-term note, 3 years, there's no principal repayment. Kailan siya magiging current? At the end of second year kasi within 1 year period na siya. Diba? How about your non-current? What are the items of your non-current? Your items of non-current from your notes receivable comes from your long-term note. So if it's with principal repayment, what is the amount of non-current? That is equal to your carrying amount subsequent to date of reporting. So if our date of reporting is January 1, year 1, subsequent carrying amount. So our date of reporting is January 1, year 1. Then our subsequent to date is this one. This is our subsequent to date. That's why that is the non-current. Clear? And then, if ever that is a non-current long-term note without principal repayment, the carrying amount is always non-current unless the note now is collectible within 1 year. Unless the note now is collectible within 1 year. Okay, so we're done with notes receivable. We're done discussing the presentation, the recognition, and the measurement. So the main problem here arises on the measurement. If you don't get the initial measurement, then your subsequent measurement is incorrect. Take note on your subsequent measurement, you can be asked what is the interest income, what is the carrying amount. So please just remember the amortization table and you look at the date that is asked. So if the date asked is, for example, in this amortization table, if the date asked is what is the interest income on December 31, year 2. So December 31, year 2, interest income, this is the interest income here. Ayan. So 173,553.72. Okay? So for notes, again, please master the initial measurement. You can master that, of course, if you know your present value factors. If you don't know how to compute for present value factors, we will have a problem. It will be hard for you, including the succeeding topics, because mostly we will use your present values. So I hope you review again your present value factors. And of course, you try to watch and compute problems as we discuss them. Okay, so that's it for our notes receivable. And that's the end of our topic for notes receivable. Thank you.